You know, the beverage industry is going through a massive, literal generational shift right now. Let's just jump right into today's explainer, where we're going to unpack Amass Brands Group. This is a company attempting to position itself right at the epicenter of how modern consumers are drinking. We're going to examine their ambitious strategy, their premium products, and most importantly, the really gritty financial realities that are hiding behind a very glamorous facade.
So think about this for a second. How do modern consumers drink, and how do they not drink? Today's drinker is completely unpredictable, right? I mean, one night you might be out having a premium craft cocktail, and the very next day you're sipping a complex, non-alcoholic botanical spirit just to unwind without the hangover. Well, Amass Brands Group was built specifically to answer both sides of that equation, capitalizing on this huge growing movement towards moderation and the whole sober, curious lifestyle.
And to really understand why this dual approach is absolutely crucial, listen to this number. By 2032, the U.S. non-alcoholic beverage market is projected to reach an astounding $246.9 billion. That is effectively $250 billion. This isn't just a passing fad or some tiny niche trend. We are looking at a seismic shift in consumer behavior. It represents a massive growth opportunity for literally any brand that can successfully bridge the gap between traditional alcohol and this rapidly expanding zero-proof space.
So how are they capturing this? By building a true multi-category beverage platform.
Amass isn't just relying on making one good drink. They're trying to build this next-generation platform for every single occasion. On one hand, we've got what they call Alcohol 2.0. This is for the drinker who wants premium ingredients, zero sugar, and a lot of cultural relevance. Think of their highly rated Summer Water Rosé or Calarosa Tequila, which is actually aged in California red wine barrels, which is pretty unique. But then, on the flip side, they're catering directly to the sober curious. You have Good Twin, which is a non-alcoholic organic wine made from real Italian Prosecco grapes, and Amass Riverine, a zero-proof spirit crafted with 14 distinct botanicals. They are heavily hedging their bets across the entire spectrum of how we socialize today.
Now, to pull something like this off, you need serious cultural cachet. Amass has successfully built this highly glamorous, culturally resonant aesthetic, and they've backed it up with major celebrity power. We're talking Katy Perry co-founding their non-alcoholic aperitif brand De Soy in collaborations with Adam Levine for Calarosa. Add in the fact that they're being poured in 5 Michelin-starred restaurants and stocked in all 27 global Soho House locations. Talk about an incredible halo effect. And they're leveraging all of that as they push into over 40,000 retail points of sale.
But, as you can imagine, building all those brands entirely from scratch takes way too much time. So, they utilized a major acquisition strategy with Winc.
To scale up fast, Amass basically bought instant market share by rescuing a fallen direct-to-consumer darling. The story of Winc is this crazy, dramatic mini-story of the modern beverage market. It was founded back in 2012 as Club W. They rode that huge direct-to-consumer wave straight to a highly touted $22 million IPO in 2021. But then, post-pandemic headwinds hit them incredibly hard. Their D2C shipments plummeted, and by late 2022, Winc filed for Chapter 11 bankruptcy. Amass just swooped in a few months later in early 2023, acquiring Winc's operating assets and dramatically expanding their own footprint literally overnight.
Now, obviously, this acquisition brought in beloved, high-performing products like Summer Water, Rosé, and Pizzolato Prosecco, but honestly, arguably the most important part of this deal was integrating key operational leadership. Aaron Green, who was Winc's former chief operating officer, transitioned into the exact same role over at Amass Brands. Alcohol and beverage supply chains are notoriously complex. I mean, they are heavily regulated and incredibly difficult to navigate. So bringing over her deep institutional knowledge of national sales, warehousing, and logistics was absolutely critical to keeping those newly acquired brands afloat.
Okay, let's talk money. How do you fund a vision like this and take it all the way to the Nasdaq?
Well, before you get to ring that opening bell on Wall Street, you have to fund the early days. And Amass capitalized heavily on retail investor enthusiasm. They raised millions through crowdfunding platforms like Start Engine. If we look at their SEC filings, they pulled in over $6 million in a Regulation CF offering in 2023 alone. If you're not familiar, Regulation CF is essentially a framework that lets everyday people, not just wealthy venture capitalists, invest in early-stage startups. So they effectively turn their future retail customers into their earliest financial backers. Pretty smart, right?
This steady capital progression, moving from those traditional seed rounds to massive crowdfunding campaigns, ultimately culminated in May 2026, when Amass achieved a direct listing on the Nasdaq under the ticker AMSS. Now, a quick note here, this was a direct listing. That means they allowed existing shareholders to trade their stock publicly without the company actually issuing new shares to raise capital on that specific day. It was a huge, triumphant milestone for a company that had started just a few years prior.
But here's where we need to take a step back and do a serious financial reality check.
Because being a public company means your books are wide open for the whole world to see. And this is where the story gets super fascinating. The contrast between Amass's trendy, glamorous aesthetic and the gritty reality of their balance sheets, it's really striking. We're going to lift the hood here and look strictly at the hard, documentary evidence from their SEC filings. No marketing spin whatsoever, just the raw data of what it actually costs to build a so-called next-generation beverage platform.
Take a look at these revenue fluctuations. While that 2023 Wince acquisition drove a massive 1,300% revenue spike, jumping from just over $3 million to over $33 million, subsequent years brought some really significant declines. By the close of fiscal year 2025, top-line revenue had contracted all the way back down to $17.8 million. It turns out, buying market share is one thing. Actually retaining it in a highly competitive, shifting market is an entirely different beast.
And the profitability data? It's a harsh reality check. Despite their incredibly impressive brand portfolio and those tens of thousands of points of sale we talked about, the costs of operations and scaling are extremely heavy. On that $17.8 million in revenue for 2025, they posted an operating loss of over $14 million. That resulted in a staggering $17.2 million net loss. The company is literally burning through significant capital just to maintain its position in the market. Now, to remain completely objective, we have to understand the structural headwinds that are actually causing these losses. First off, consumers are simply drinking less wine across North America right now. Second, cash management issues forced AMSS to pause their original core spirits business. But the biggest blows? Supply chain disasters. A major customer defaulted on a multi-year production agreement where AMSS was already selling goods below cost. And even worse, AMSS had to record a $2.9 million liability. Basically, they signed firm contracts to buy bulk wine at high prices, and then the market value of that wine just completely crashed, so they are locked into paying a premium for devalued assets. Ouch. Yet despite these really heavy financial hurdles, leadership remains incredibly optimistic. CEO Mark Thomas Lin maintains that they've built a uniquely differentiated platform. The whole executive belief here is that by having their hands in functional, non-alcoholic, and premium alcoholic categories, they're positioned to benefit structurally rather than just reactively as consumer habits continue shifting toward moderation.
Which brings us to the big question. Because having incredible product market fit and a beautiful brand does not automatically equal a profitable business model. So I want to leave you with this final thought. In the modern economy, can undeniable brand equity and cultural relevance outrun a balance sheet that is bleeding cash? Can Amass scale fast enough to outpace the harsh financial realities of the beverage industry, or will the immense costs of scaling ultimately drain the glass dry? It's a really high-stakes race, and the public markets are definitely watching closely. Thanks for joining me on this explainer, and I'll catch you on the next one.